Hey, welcome back to the channel. Let me cut straight to it. Bitcoin just had one of its worst weeks of 2026. We're talking a 9.5% drop in 7 days, a plunge to $65,708 intraday, over $1.7 billion in leverage positions wiped out in a single day, and the longest ETF outflow streak in the entire history of these products, 11 straight sessions, $3.4 billion out the door. And I'm going to tell you exactly what that means, where we go from here, and why, believe it or not, there's a case being made right now that Bitcoin is trading at a fraction of its real value. Here's what we're covering today. First, the full picture on this ETF bloodbath, the numbers, the context, and what Wall Street's own analysts are saying about it. Second, the macro threat nobody's connecting the dots on. We're talking $29 trillion in sovereign debt issuance in 2026 alone, and a model from Bitwise that puts Bitcoin's theoretical fair value at $224,000. Third, the Mt. Gox ghost, $739 million in BTC just moved, and the market is spooked. And finally, the debate everyone in this space is having right now. Is $60,000 the next stop, or is this the setup for the run back to $85,000? If you haven't subscribed yet, hit that button right now. We do this every single day. Let's get into it. Okay. So let's start with the ETF situation, because this is the engine behind everything that's happened this week. According to data from SoSoValue, U.S, spot Bitcoin ETFs just completed 11 consecutive sessions of net outflows, the longest streak since these funds launched in January 2024. The previous record was 8 days, set back in February 2025. We just blew past that. Total outflows across those 11 sessions, approximately $3.45 billion. The most recent session alone saw investors pull $484 million out of these funds in a single day. Let that sink in. We went from Bitcoin ETFs being the hottest financial product in the world, pulling in billions of dollars of institutional capital every week, to 11 straight days of people hitting the exit button. This is not a rounding error. This is a structural shift in short-term sentiment. Now, what's actually driving this? CoinDesk reported that the outflow streak began on May 15th and accelerated as Bitcoin's price slid from above $80,000 in early May all the way down to where we are now, around $66,000 to $67,000. And Citi, yes, that's Citi, one of the biggest banks on the planet, published a report today that I think is one of the most important reads of the week for anyone holding Bitcoin. Their analyst Alex Saunders laid it out plainly. He said ETF flows account for roughly 45% of Bitcoin's weekly price movement. Not sentiment on Twitter, not sailor tweets, not even geopolitics, ETF flows. That's the single most important variable driving the price of Bitcoin right now, according to Citi's own quantitative model. And right now, that variable is deeply negative. But here's where it gets interesting. Citi also said that Strategy's Bitcoin sale, which we'll talk about more in a moment, was not the real story. The real story, according to Saunders, is the absence of new buyers. The market is not being destroyed by sellers. It's being starved of demand. That is a fundamentally different kind of problem. CryptoQuant backed this up in their weekly report, warning that Bitcoin is increasingly becoming a market of holders rather than buyers. Accumulation through ETFs and corporate treasuries has slowed markedly over the past several months. The product is still there. The infrastructure is there. But the fresh capital flowing in has dried up, and I'll tell you what that really means. It means the $126,000 all-time high from October 2025 was built on a specific combination of institutional momentum, ETF inflows, and corporate treasury accumulation, primarily driven by strategy, all happening at the same time. That combination is no longer firing on all cylinders, and when the fuel runs dry, gravity does its job. The question, the one everyone's asking, is whether this is a temporary drought or something more structural. I'll give you my read on that after we go through the other pieces of today's picture. Because here's the thing, at the exact same moment that Bitcoin is falling, the stock market is at record highs. NASDAQ, S&P 500, both near all-time peaks. Nvidia up 6% in a single session. AI stocks absolutely on fire. And Bitcoin down 9.5% on the week. That divergence, crypto falling while equities rip, is what CoinDesk is calling a critical juncture, and it matters for a very specific reason. For most of 2024 and 2025, Bitcoin and equities moved together. They were correlated. Risk on meant both went up, risk off meant both came down. That relationship is now breaking down, and it's triggering real concern among institutional players who use that correlation as part of their allocation models. When Bitcoin goes down while everything else goes up, it stops looking like a risk-on asset and starts looking like something else entirely, something broken. Or, alternatively, and this is my read, something so deeply undervalued relative to its actual fundamental story that the market simply hasn't caught up yet. Which brings me to the most important analytical piece of the day. Bitwise Europe published their monthly research report this week, and it contains a data point that I genuinely believe is being massively under-discussed right now. Their researchers applied a theoretical framework originally proposed by analyst Greg Foss back in 2021. And the number they came up with for Bitcoin's fair value is $224,000. Now, before you dismiss that, hear me out, because the logic here is actually serious. Foss's model treats Bitcoin as a credit default swap on G20 sovereign bonds. Here's the idea. A credit default swap is essentially insurance against a borrower defaulting. It pays out if the government or corporation in question can't meet its debt obligations. The price of a CDS reflects the market's assessment of how likely that default is. Bitcoin, because it has no central issuer, no sovereign backstop, and operates entirely outside the government financial system, functions as a non-correlated hedge against exactly that kind of sovereign default risk. Bitwise took the weighted default probabilities across all G20 countries and the total market cap of the sovereign bonds being notionally insured, and the math spits out $224,000 per Bitcoin. Now, and this is critical, Bitwise is explicitly calling this a model-implied illustrative figure, not a price target. They're not saying Bitcoin goes to $224,000 next month. They're saying, if the world starts treating Bitcoin the way it theoretically should be treated, given the sovereign debt situation we're actually in, this is what fair value looks like. And the sovereign debt situation is genuinely alarming. The IMF and the OECD have both warned that governments and corporations are on track to borrow $29 trillion from bond markets in 2026 alone. That's 17% higher than 2024. And here's the number that should stop you cold. 78% of that borrowing is not funding new infrastructure, new schools, new roads. It's rolling over existing debt, paying off old I owe us with fresh I owe us. The global economy is running a Ponzi structure on its sovereign debt, and almost nobody in mainstream finance wants to say it out loud. Japan is the clearest example. Their 30-year government bond yields just hit record highs. Their 10-year JGB yields are at multi-decade peaks. Japan has a debt-to-GDP ratio of approximately 230%. They hold $1.2 trillion in U.S. treasuries. The second largest sovereign bond market in the world is flashing warning signs that nobody in traditional finance wants to look at directly. Bitwise also highlighted that 10-year swap spreads, which measure sovereign risk premia, are at their highest levels since the 2011 to 2012 European debt crisis. Not since the pandemic, not since the banking crisis, since the European sovereign debt crisis. And where is Bitcoin trading right now? Around $66,000 to $67,000. That's approximately $150,000 below what this model says it's worth as a hedge against exactly the risks that are currently materializing in real time. Now, I'll be honest with you. Bitwise also flagged near-term headwinds. Bitcoin's MVRV ratio, a metric that compares its market value to its realized value, is sitting in the lower half of its historical distribution. Only 36% of historical readings are below where we are right now. That's actually a bullish signal from a cycle perspective. It says we're not at a top. We may be close to a floor. By contrast, the NASDAQ 100's price-to-book ratio is at its highest level on record. 99% of historical readings are below where it is right now. In other words, equities are at an extreme valuation by historical standards, and Bitcoin is not. The market is currently preferring the overvalued asset. That kind of dislocation does not typically last forever. Now let's talk about the other cloud hanging over this market, Mt. Gox. On June 2nd, the defunct exchange moved 10,422 Bitcoin, worth approximately $739 million, to a new wallet. This was recorded in Bitcoin block 952,072 at 0447 UTC, confirmed by Arkham Intelligence. Of that total, 10,306 BTC went to a previously unseen address, while 116 BTC went to a known Mt. Gox hot wallet. This is the exchange's largest single transfer in months, and it landed right in the middle of one of the most fragile stretches of 2026 for the Bitcoin market. The timing could not have been worse from a sentiment perspective. Here's the context you need to understand. Mt. Gox still holds approximately 34,504 BTC, valued at around $2.43 billion, ahead of a final creditor repayment deadline of October 31, 2026. The trustee, Nobuaki Kobayashi, has already pushed that deadline back twice. The creditors who are owed this Bitcoin, roughly 19,500 of them, bought before the 2014 collapse. Some of them bought at prices that would make even today's $66,000 look expensive by comparison. When they receive those coins, many are going to sell. That's just reality. Now, and I want to be very clear about this transfer does not mean Mt. Gox has started selling. The CoinDesk report was explicit. The coins moved to a new wallet, not to a known exchange address or custodian. No direct sell signal was confirmed at the time of reporting. These types of administrative transfers have happened before without immediately preceding distributions. In fact, the last major Mt. Gox move, in November 2025, preceded a 15% drop in BTC over the following month. The one before that, in November 2024, actually preceded a 49% gain over 30 days. So history here is genuinely mixed. But, and here's the honest truth, in a market that's already nervous, where ETF outflows are at records, where strategy just broke its never sell streak, where Bitcoin is testing critical support levels, a $739 million move from the most infamous failed exchange in crypto history is not a nothing event. It adds overhang, it adds uncertainty, and markets hate uncertainty. The key levels traders are watching: $65,000 as near-term support, with $60,000 as the next major floor if that breaks. On the upside, $68,700 as the first meaningful resistance, and $72,000 as the level that would genuinely change the short-term structure. Over $1.7 billion in leveraged long positions were liquidated in the past 24 hours, double the amount from the day before. Open interest in Bitcoin futures is sitting at record highs above 800,000 BTC even as spot prices decline. That's significant. It means new short positions are being opened aggressively. Bears are not just refusing to buy, they're actively pressing. The 7-day cumulative volume delta is deeply negative, meaning selling is being done with market orders, not patient limit orders. This is not passive repositioning. This is active conviction on the bear side right now. So let's get to the debate, because this is the conversation I want to have with you. Is $60,000 the next stop? Or is this the setup that sends Bitcoin back to $85,000? The bear case is real, and I'm not going to pretend otherwise. 11 sessions of ETF outflows. $3.45 billion drained from the primary institutional demand vehicle. The Clarity Act, the crypto market structure bill that was supposed to be a major catalyst for fresh institutional inflows, is losing momentum in the Senate according to CoinDesk's policy team. If that bill stalls, one of the last remaining near-term catalysts evaporates. Bitcoin has lost the $72,000 and $68,000 support levels. Open interest is at record highs on the short side. The options market is pricing significant probability of a move to $55,000 by late June. The most actively traded option contract on Deribit right now is the $55,000 put expiring June 26th. That's not noise. That's institutional positioning. A clean break below $65,000 opens the door to $60,000 very quickly. And below $60,000? The 200-week moving average sits somewhere between $60,000 and $61,000, a level that has historically been one of the most important long-term floors in Bitcoin's entire history. But here's the bull case, and I think it deserves a fair hearing. Bitcoin's MVRV ratio is in the bottom third of its historical range. Long-term holders are not moving their coins. CoinDesk's derivatives data shows that while open interest is high on the short side, funding rates are only slightly negative, meaning the bearish trade is not yet overcrowded. When a trade gets overcrowded, it unwinds violently. An overloaded short position is fuel for a short squeeze. And if even one of the macro catalysts flips, if the Fed pauses under new chair Kevin Warsh, if the Clarity Act makes a surprise comeback, if ETF flows reverse even slightly, You could see a move that catches the bears completely offside. The Bitwise report is also pointing to a scenario where the sovereign debt narrative, Japan's bond market, the $29 trillion borrowing calendar, the rising swap spreads becomes impossible for mainstream investors to ignore. When that moment comes, Bitcoin's positioning as a non-sovereign hedge becomes the most powerful bid in the market. My honest read? This is not the end of the bull cycle. This is an extremely painful mid-cycle correction in a macro environment that has temporarily flipped hostile to Bitcoin. The same institutional infrastructure that brought us to $126,000 is still there. The ETFs exist. The corporate treasury playbook exists. Strategy still holds over 550,000 Bitcoin. BlackRock's IBIT is still the largest Bitcoin fund on the planet. None of that disappears because of 11 bad days. But 11 bad days can absolutely become 30 or 60 bad days if the macro environment doesn't cooperate. And if $65,000 breaks with conviction, watch $60,000 fast and prepare for the possibility of testing the 200-week moving average. I'm not panicking, but I'm watching every single data point like a hawk. Before I close out today, one quick wildcard story I want to mention because I think it's actually a beautiful piece of Bitcoin history. A physical Cassius coin from the 2011 to 2013 mint, 25 BTC embedded under a tamper-evident hologram, created by software engineer Mike Caldwell, had its seal broken this week. The 25 BTC, worth approximately $1.78 million at current prices, were swept on-chain to a new wallet. Galaxy Research confirmed the event, identifying the coin as S1-Coin-25 at address 1TLPQWD6WJVZPREIVWHSEUU2CESV6ZAON. These physical Bitcoin coins are legendary in this space. They embed real Bitcoin under a hologram. Peel the hologram, and you get the private key. Leave it intact, and the coin trades as a collectible for more than its face value. When someone peels one of these, they're making a choice. Take the Bitcoin, destroy the artifact. And someone just made that choice on a coin that's been sitting untouched for over 12 years. Think about that for a second. Someone held 25 Bitcoin from 2011 or 2012 all the way through every crash, every recovery, every bear market, the whole decade-plus journey from a few dollars to $126,000 and back. And this week, at $67,000, they decided it was time. Maybe they needed the liquidity. Maybe they saw the Mt. Gox headlines and got nervous. Or maybe they just did the math and decided $1.78 million in actual spendable money beats holding a rare physical artifact through another cycle. We'll never know. But I love that story. It's very Bitcoin. This also comes in a week of unusual dormant wallet activity, by the way. A 2011-era wallet that had been completely inactive for 15 years just moved 35 BTC. Something is stirring at the very oldest layers of the Bitcoin blockchain. Worth watching. All right, let's wrap it up. Here's what you need to take away from today. 1. The ETF outflow streak, 11 sessions, $3.45 billion, is the single most important data point in the market right now. Citi says ETF flows drive 45% of weekly BTC price action. Watch the daily flow data from So Value. A return to net inflows would be the first real signal that sentiment is turning. 2. The Bitwise $224,000 model is not price prediction. It's a structural argument about Bitcoin's role as a sovereign default hedge in a world drowning in government debt. With $29 trillion in sovereign borrowing scheduled for 2026 and Japanese bond markets flashing 2011 level stress, the macro narrative is building. It doesn't move prices today, but it moves them eventually. 3. Mt. Gox moves $739 million. No confirmed selling yet, but the overhang is real. October 31, 2026 is the deadline. This story isn't done. 4. The levels that matter. $65,000 support holds, or we test $60,000. Above $68,700, the structure changes. Stay close to the data. Before I sign off, a quick but important reminder. Everything you heard today is strictly informational and educational. We cover the main Bitcoin news and market movements of the day. Nothing in this video is a recommendation to buy or sell any asset. Do your own research. Make your own decisions based on your own risk profile. Every situation is different. This channel has no affiliation with any exchange, fund, or financial institution. If this video helped you make sense of what's happening in the market, Hit the like button. It helps the channel more than you know. Subscribe if you haven't already. Turn on notifications so you never miss a daily episode. And drop a comment. Do you think we test $60,000 before we see $85,000 again? I read every single one. Tomorrow we're going to be watching ETF flow data closely and looking at whether the options positioning in the $55,000 puts starts unwinding, because that could be one of the earliest signals of a sentiment shift. Don't miss it. Stay sharp, stay informed, and I'll see you tomorrow.